Hi, welcome to this edition of Conversations with Claris. Today we have Chris Bettonville with us today. Chris, we get our clients from time to time asking us about, hey, what is it with this growth versus value premium that you guys always talk about? Can you give us a little explanation about what that is?
Yeah, so growth stocks, value stocks, same with mutual funds, it's just comprised of growth and value companies within those, are just asset classes, very similarly to large cap, small cap. I think those are a little easier for clients to wrap their head around, large cap, large companies, small cap, small companies. But when it comes to growth and value and the relationship or differences between those two and why they're used is a little hazier. So I think just a high level overview, growth stocks or companies, those tend to be companies that have, an expectation of large, rapid growth to earnings and sales, right? People expect them to do well. Their financials, they're usually kind of priced high for some of their financials. Oftentimes we hear some of them, their profitability, they're losing money, not making a profit, but they're still expected to grow and rapidly bring in more money. So that's where that expected return is going to be on the meeting those expectations of growth. On the other side there, we have value stocks or value funds. Those are going to be usually more established companies with very solid financials and fundamentals, because ultimately the stock price they're trading at relative to those great solid fundamentals is what makes them discounted, or as we like to kind of think of it as they're on sale. Buying something on sale, waiting for that value to go back up and knowing that there's a solid base that it's built on. So people then want to ask, well, which one's better then? Right? You have the two. Is one better than the other? Well, we at Claris, we believe in evidence-based investing, and there is evidence, a lot of solid backing that over the long term or over a long investment horizon, value does indeed outperform growth. That's not to say growth isn't important. We do have growth in our portfolios. It's important to diversify and not put all your eggs in one basket. But when we do build out a portfolio, knowing that value does outperform growth over that long term, we do tilt that portfolio to kind of capture some of that value exposure and ultimately capture those value premiums that value's going to have over growth.
Right. And it's kind of a cost of capital story, isn't it? Right. If a value company is out there, back in the day, maybe like an airlines company was out there, if they wanted to get investors to invest and they were expecting a higher return in return for those dollars being invested. To your point, a growth company like a Walmart, the cost of capital for them, very slim to go out and get investors, right? They understood they didn't have to pay this high premium, the expected return. Solid return, but not necessarily like a value company. So, Chris, thanks for explaining and give us a little insight on the differences between value and growth. We appreciate it. Thanks for tuning in. Join us next time and we'll have a new topic for you.